Okay. So second module, the future of money. So part A starts from digital currency. So money can be defined as something that is accepted for payments and repayments. And the primary functionality is a medium of exchange and a measure of value or unit of account. And the secondary functionality is standard of deferred payment and store of value. So, financial instruments are monetary contracts that take place between parties, and all the available financial instruments within an economy are referred to as the money supply for a specific economy. The properties of money, to fulfill these primary and secondary functions, the money needs to be fungible, so it needs to be interchangeable, durable, long lasted, portable, recognizable, stable, divisible, and it needs to be scarce. So the difference between money and currency is money is a store of value. It is tangible, it has intrinsic value, and it can be used to derive value of any product or service. Whereas currency is not a store of value, it is tangible or intangible. It does not have intrinsic value and it can't be used to derive value of product or service. So the traditional currency can be commodity backed, fiat currency, and representative or fiduciary currency, whereas digital currency can be regulated, so something like e-money, or unregulated like virtual currencies. So commodity currency is a physical commodity used to represent money, so something like coined metals or cocoa beans. The advantage of this is it has lower inflation and devaluation. It is able to serve for additional purpose, so like gold jewelry. Seigniorage, so it's the profit made by a government when it issues currency, is impossible, and it has little to no political influence. Whereas the disadvantage, there's a manipulation of allocation and usage. There's supply limitation, is prone to fluctuations in value. It has mutual matching of needs and quantities. It is almost impossible to divide into small denominations. It can be difficult to transport or carry, and it can be perishable. The variations in quality can be observed. Commodity-backed currency, so it can be exchanged on demand for a commodity, but does not use the commodity itself as the medium of exchange. So the advantage would be it has lower inflation, it has less governmental influence, it has intrinsic value, and less risk of deflation. Hence, it is better as a saving medium. But it is prone to devaluation. There are variations in quality. It has slower economic growth, relatively fixed in supply, volatile, and more costly to produce than fiat currencies. Fiat currency is issued by a government as a legal tender, and it is not backed by a physical commodity. So I guess fiat currency is like what we use Australian dollar. Advantage is it's established, it is more stable and more growth in terms of supply. The disadvantage, it can be counterfeited, it's insecure, it has high transaction fees, contrary to the digital currency. It has inflation and the value is pegged to government. So currencies may be fully convertible. So for example, US dollar is fully convertible. There's no restrictions or limitations. It's partially convertible, so controlled by central banks like Chinese renminbi. And it's non-convertible currency, so there's neither participation in the international currency market or conversion is allowed. So something like North Korean won, Cuban peso, currencies like that. There's representative or fiduciary currency, so they're based on the promise provided by the issuer to exchange it for a commodity or fiat currency upon request. So the most widely used fiduciary currency is the bank check. The advantage of fiduciary currency is pegged to fiat currency or commodity, but commodity is rare. It's a paper certificate and it is easy to carry, but the disadvantage is the value depends on confidence, good faith, and trust. It's not enforceable, accepted medium of exchange. It is prone to counterfeit and it can be manipulated. Digital currencies exist only as balance or records stored within databases. So e-money is regulated digital currency. A virtual currency is an unregulated digital currency, and a cryptocurrency is a decentralized virtual currency. So virtual currency is unregulated digital currency. So cryptocurrency is a decentralized, unregulated digital currency. So e-money, so electronic money, the advantage of that would be it is backed by fiat currency, it is practical to use, faster transactions, global transaction, traceable, reduces fraud and circulation of black money. Whereas the disadvantage would be can increase consumption and uncontrolled spending, which is very subjective. There's fees for cross-border transactions, it is prone to cybersecurity risk and hacking, there's loss of privacy, and it can create societal inequalities and lead to financial exclusion. There's hardware-based products and software-based products. So hardware-based would be something like credit cards, where it is a physical element, whereas software, it operates on devices such as computers or smartphones. Central bank digital currency is a digital form of country's fiat currency, which will be backed, regulated, and administered by governments. So this is widely used in China, CBDC. They recently announced the development of the sovereign digital yuan. I don't know if I pronounced it right, but the currency is issued by a central bank in a digital form. It provides the freedom for anyone to hold it. It is the same currency as banknotes or central bank deposits. The currency can serve as a payment mechanism, and it does not depend on a third party or central counterparty to verify or process transaction. So there's a real-time settlement. So what's the benefit of a cashless society? It would reduce crime as there is no physical money to steal, reduce money laundering as cashless transactions are traceable, is more cost effective as there's no need to print, seamless foreign exchange transactions as they will not need to involve handling of cash. The disadvantage would be as currency becomes data, cybersecurity becomes a threat, compromised privacy as cashless transactions are traceable, reliance on availability and scalability of technology to enable transactions, reliance on interoperability of systems, fees charged by payment service providers, potential exclusion of those who has limited access to technology or skill. Virtual currencies are created by developers of online virtual communities or platform. The advantage is cheaper, faster, potentially more secure, more transparent, convenient, and centralized or decentralized. Disadvantage is no consumer protection, potential instability of platforms, price volatility and fluctuations, cyber threats, unregulated, not backed, no intrinsic value, potential security issues. So centralized virtual currencies are controlled by a single administrator, so usually the developer of the platform, who acts as the intermediary in the transactions, whereas decentralized virtual currencies use cryptography to establish trust between participants and thus eliminate the need for an intermediary. What does that mean? So centralized virtual currency has intermediary, so it is regulated, it is controlled by an administrator, whereas decentralized, it has no intermediary. So closed virtual currency is also known as fictional currency, or when it is used only for virtual goods and services. It is used in specific virtual communities. Since there's no use beyond the boundaries of the virtual community, there's no regulation on this. Whereas unidirectional, it can be used for virtual and real goods and services. So something like loyalty programs like frequent flyers, you can earn points and use to buy actual products. Convertible or bi-directional virtual currency, also known as open virtual currencies, it can be purchased and sold using conventional currency at an exchange rate. You can convert your virtual currency into the real currency when it comes to convertible bi-directional. So cryptocurrencies are decentralized virtual currencies, and the advantage of it is secure. It has secure transactions without supervision. It has open transactions and transparent to all users, and it is private, potentially anonymous. But the disadvantage would be it is very volatile. I mean, some are, but it's volatile. It's energy intensive due to the computing requirements and the possible association with illegal activities such as money laundering, and it is unregulated. So there's a summary of all of this. So cryptocurrency and virtual currencies are unregulated, whereas e-money is regulated. The governing structure of cryptocurrency is P2P through blockchain network of computers. E-money is supervised by central authorities such as Reserve Bank of Australia. The virtual currency has no supervision from central authorities but monitored by the issuing organization. The issuer of cryptocurrency is the users in the cryptocurrency network. For e-money, it is the central bank or public authority, and for virtual currencies, it's the organization. The value of cryptocurrency is determined by the supply and demand of cryptocurrency in the market. For e-money, it is determined by the fiat currency, and virtual currencies, it is determined by the issuing organization. Cryptocurrencies are converted to fiat currency equivalent based on the market price of cryptocurrency. E-money is easily converted as it is a digitally stored representation of the fiat currency. But not all virtual currencies are convertible to fiat currency. So for convertible virtual currencies, conversion rate is fixed by the issuer. For examples of cryptocurrencies are Bitcoin, Ether. For e-money, it is the e-money stored in digital and mobile wallets, so on PayPal, Apple Pay, wallets like that. Virtual currency, something like Qantas frequent flyer points. So part B, a payment is a transfer of funds, assets, or goods or services in exchange for another forms of funds, assets, or goods or services. A digital payment refers to an exchange in which value is transferred electronically from one party to another. So payment systems, so something like large value payment systems, processes large volumes of high value critical payments. Retail payment systems, so it involves routine purchasing and selling of goods and services. Common payment methods for personal and business consumers. Direct deposit is when customers instruct banks to take funds from a bank account to complete an online payment. So this is an automated clearinghouse payment. Digital wallets, so something like PayPal, BPay, MasterPass, Alipay, Visa checkout, so it stores customer information, funds information, and money transfer information. Mobile wallets, so mobile-based digital wallets. It's mobile wallets use near-field communication, NFC, to connect with a point-of-sale terminal, POS terminal, so Apple Pay, Samsung Pay, Android Pay. Prepaid cards, it's store value that customers can spend at a selected merchant or a range of merchants. So direct credit is ideal for payroll payments, whereas direct debit service is ideal for managing payments from customers. They're both automated clearinghouse payments. And credit cards, this would require a payment gateway, POS. Automatic payments, so this is ideal when there's a fixed or regular transfer. Whereas one-off payment is one-off payment, direct credit. Bill payment, paying for utilities. Funds transfer, Yeah, that's just funds transfer. Direct debit. So this is an automatic payment attached to a debit or credit card. This is ideal for utility or other service payments, and it's an automatic clearinghouse payment. Check is a formal promissory note, usually issued through a bank checkbook. Cryptocurrency is decentralized and distributed payments. Hybrid payments combine multiple payments technologies and include smart payments, contactless payments, biometrics, stablecoin, buy now, pay later. Payment gateway enables digital payments by transmitting customer transaction information to the business's merchant account, where funds are held until the transaction is cleared. The payment gateway sits between the POS, point of sales terminal, and the company's internal systems. So it's in between that. It receives, authorizes, and fulfills payments made by cards and other contactless technologies. A payment service provider or third-party payment processing company provides merchants with everything they need to access digital payments. PSPs usually provide both a merchant account and payment gateway. EMV, so EMV stands for Europay, MasterCard, and Visa, is a global standard for payments that deals with authentication and security of chip card transactions. Near-field communications are equally secure to EMV payments. There are 4 types of digital payments: card-based, electronic fund transfer, digital wallets, and hybrid. So card-based, so there's debit card, credit card. Electronic funds transfer, so direct debit, direct credit, unified payments interface. Digital wallet, so mobile-based, platform/online-based, mobile application, cryptocurrency wallet. And hybrid, so smart and contactless, for example, tap and go, biometrics, fingerprint, buy now, pay later, crypto enabled, and stable coins. So advantage of digital wallets would be it is convenient and comfortable. No need for access to cash, physical cards, or account numbers. It can hold many different types of cards. The information is securely stored within a third-party system. It is widely accepted around the world. It can track spending habits and promote better financial health, wellness. It is cost-effective for retailers because there's no need for human tellers or cashiers. It can be a competitive advantage for the merchant, and it can support scalability of business and provide access to new revenue stream. But the disadvantage would be not all retailers may accept all kinds of digital wallets. Consumers still need to carry a smart device, and it needs to be electronically charged. The security depends on the device setting and up-to-date software. Depending on the merchant, wallet, and POS terminal, additional charges may be incurred. Equally to irresponsible and uncontrolled spending, systems outages can prevent merchants from processing, and encryption of customer information requires constant update and maintenance to avoid privacy and security issues. Now we're at the distributed ledger technology part. So centralized database is when there's a single storage device in a distinct location. Although it is easily developed and maintained, it can be slow because of volume of data, and there's a risk of loss of access. Decentralized databases is distributed over multiple interconnected storage devices in different physical locations. These provide faster access and are more scalable as the volume of data and numbers of users grow. Distributed databases, it reside on all the computers participating in the network, so they're called nodes. And a specific type of algorithm called a consensus algorithm synchronizes the data across every participating computer. Since changes made to the database on one computer are replicated, all participating computers need to be verified. So this is a very complicated database and it is very costly to set up. But this is how cryptocurrency, the blockchain network, operates. So permissionless ledger is a distributed ledger without a specific owner, and anyone can add data to a permissionless ledger, whereas permissioned ledger is a distributed ledger with a defined set of owners. So the advantage of distributed ledger technology will be it is reliable, it has instantaneous settlement, it has a recording of ownership, lower communication costs, increased transparency, high security, and the records of transactions are immutable. But disadvantage would be scalability, operational risk, inability to modify, cancel, or revoke those transactions, potential high efforts to achieve consensus, it is costly to implement. So how a blockchain processes a transaction? It first adds new data entry, and the miners generate block, and miners are the nodes that specialize in adding new data to the blockchain. The nodes validate the new block added to the blockchain becomes permanent and immutable, and confirmation of entry is added to the address book. Proof of work is based on a principle that a difficult mathematical puzzle has to be solved by miners, and the solution has to be proven easily by the nodes so that it is impossible for the attackers to manipulate the network. And the larger the network, there's more resistance to manipulation, which makes sense because there's more puzzles to solve. Whereas proof of stake is a consensus mechanism in which users who have stake in the system are granted the opportunity to validate blocks and earn rewards. Blockchain is able to prevent double spending by time-stamping blocks of transactions. So in a public blockchain, every user is allowed to begin interacting with the network by submitting transactions. Whereas private blockchain is invitation-based. Private blockchains are closed ecosystems that are governed by one organization that is responsible for participation, consensus protocol, and shared ledger maintenance. So it is invitation-based, and examples are Ripple and Hyperledger. Permissionless blockchain has no central authority. So there's a maximum level of transparency because it's open to anyone, but it is slow to operate due to high level of security. So potential use cases of these permissionless blockchains can be voting, fundraising, and digital identity. Permission blockchains have a control layer that grants access to accepted users. So private permissioned blockchains allow for additional governance structures, making them organized and easier to administer. It involves fewer nodes, making the consensus algorithms operate more efficiently, but it tends to be less secure as their security relies on the integrity of the members. The potential use case includes supply chain management, banking and payments, and food tracking. Hybrid blockchains is the combined concept of private and public blockchains. Consortium blockchains are a special hybrid between private and public blockchains, often considered as partly decentralized. This is achieved by a pre-selected set of nodes controlling the consensus process. So for example, whilst authorized users can provide data, test data and certifications to the network, consumers can publicly access the history of individual food items from farm to store. So okay, let's just look at this table. So public blockchain is permissionless, whereas private and consortium blockchains are permissioned, and hybrid is both. Public blockchain is not centralized, private is centralized, and hybrid and consortium is partially centralized. There is a high participation in public blockchain, whereas lower participation in private, hybrid, and consortium blockchain. Public blockchain can be written by the public, whereas private, hybrid, and consortium have restriction in writing, or it is upon invitation only. When it comes to reading, public blockchain can be read by the public, but private and consortium have restrictions. When it comes to efficiency and speed, public blockchains are very low in that, whereas private, hybrid, and consortium have high efficiency and speed. Public blockchains cannot be tempered with, whereas it can be tempered with for the others. There's no trust among participants in the public blockchain, whereas the others have trust among participants because invitation only. Smart contracts are transactions that self-execute based on a set of programmed conditions. It is still in the proof of concept stage, but it is increasingly feasible. And a major shortcoming of current smart contract is their inability to push outputs to external systems, but it can be somewhat overcome by a blockchain intermediary called Oracle. Ethereum was designed as a general purpose blockchain that would enable the creation of smart contracts. The platform is adopting a number of measures as part of the transition to Ethereum 2.0. Sharding is partitioning the blockchain into separate but interoperable chains so that multiple transactions can be processed simultaneously. Proof of stake is replacing the proof of work consensus mechanism with the faster and more scalable proof of stake mechanism. So when it comes to tokens, there are 3 types of tokens: security token, utility token, and currency token. Security token is like a direct investment. Utility token is specific to its needs and it cannot be redeemed for other services. And currency token is currency. So Oracle is a live feed of data from external systems that are continuously monitored and treated as a source of truth. It is used to trigger execution of a smart contract, and it can be sensors that obtain data from physical objects or software. So the benefits of utilizing smart contract will be speed, precision, trust and safety, fewer intermediaries, lower cost, and new operational models. So a system is classified as a cryptocurrency if it meets these following 6 conditions. So the system is decentralized and is run by means of distributed consensus protocol. System is able to keep an overview of the cryptocurrency units and their ownership by users. The system defines if and how new cryptocurrencies can be created. It is able to prove a user's ownership of cryptocurrencies units only by means of cryptography. The system can enable transactions that can result in changes in the ownership of cryptocurrency units. If 2 different transaction instructions are entered at the same time, the system can select one transaction only. A taxonomy of cryptocurrencies. There's coins, tokens, and stable coins. Coins, there's currency coins and privacy coins. For tokens, there's utility tokens and security tokens. And for stable coins, there's fiat collateralized stablecoin, commodity collateralized stablecoin, non-collateralized stablecoin, and consortium stablecoin. So currency coins have their own blockchain within which they function as a currency. So currency coins that are not Bitcoins are called altcoins, alternative cryptocurrencies. Examples of altcoins are Litecoin, Ether, XRP, which is the cryptocurrency of Ripple platform. Privacy coins facilitate monetary or information transactions between users in full anonymity. Monero cryptocurrency platform, XMR, is an example. It enforces privacy, conceals participants' information, but users can choose who can see their transactions. So due to the untraceability of transaction, XMR is the most prominent currency on dark web markets. Tokens operate on top of an existing cryptocurrency blockchain network. So they are dependent on the blockchain network of another cryptocurrency. Tokens can represent a real asset, so tokenization, and it is usually released via an ICO, initial coin offering process. Utility tokens are tokens for accessing dedicated products or services associated with the token, whereas security tokens are the tokens that represent a stake in a real-world asset. Stable coins are backed by real-world assets or benchmarks with the intention of making them less volatile than other currencies. Fiat collateralized stable coins are pegged to one or more fiat currencies at a fixed ratio. Asset collateralized stable coins are backed by one or more commodities. Crypto collateralized stable coins is linked to one or more other cryptocurrency by means of smart contract. Non-collateralized stablecoin is algorithmically regulates the supply of coins to stabilize coin prices, and consortium stablecoins is issued by groups to enable instant cross-border payments. So decentralized finance is the application of blockchain-based software to create financial services independent of centralized intermediaries and authorities. So the obvious advantage of decentralized finance is the lowering of barriers to entry. It has augmented commercial opportunities and financial inclusion. But the disadvantage is it runs the risk of cyber attack, and it is not yet regulated. Part E, alternative finance providers. So alternative finance is any form of financing through sources outside the conventional financial systems. For example, debt, investment-based or financial return, or non-investment-based or social. So under the debt category, there's P2P marketplace lending, so consumer and business lending, balance sheet lending, invoice trading. For investment-based or financial return type, there's equity crowdfunding, real estate or property-based crowdfunding, and profit sharing. For non-investment-based or social, there's reward-based crowdfunding and donation-based crowdfunding. So key attributes of peer-to-peer lending are the interest rates may be more flexible, the borrower is legally required to repay the loan, the disclosure requirements are publicly available, a loan which was not granted by a bank can be granted in this scheme, there is no predetermined size for a loan, and in most cases the repayment of the loan is processed via the online platform by means of direct debits. Balance sheet lending or portfolio lending provides a loan directly to a consumer or business owner via an electronic platform. So the platform sources money from capital markets and investors as debt or equity and hold it on their balance sheet as an asset. The platform then lends the borrower money and assumes the risk itself, in contrast to peer-to-peer lending in which the platform does not itself lend the money. So when it comes to the balance sheet lending, the platform is actually lending the money. So the platform is liable if there are losses in the portfolio lending. The revenue is generated based on interest rate spread. The disadvantage would be high cost for the borrowers. So when you compare P2P and balance sheet lending, peer-to-peer lending, there's loan is facilitated by the platform. The platform does not need to have a banking license. Loan issued at the risk of the peer-to-peer investor. It attracts fees for service. There's no additional cost to cover losses, and there's continuous balancing of capital lending and supply. Whereas for balance sheet lending, the loan is issued by the platform. A platform needs to have a banking license, and loan is issued at the risk of the balance sheet lender. And cost structure is considered less transparent. Invoice factoring, it involves a contractual agreement with a third-party provider which is responsible for managing the entire sales ledger. Such providers usually contact customers directly in order to collect payments. Whereas invoice trading, it allows businesses to sell individual outstanding invoices through electronic platforms to obtain working capitals. Invoice trading is considered to be asset-backed lending because the invoice serves as collateral. When it comes to the difference between invoice factoring and invoice trading, invoice factoring tends to dictate what is sold, and usually the seller has to sell everything, whereas invoice trading, seller retains control of which invoices are sold and when they are sold. When it comes to transparency, can have unanticipated or undisclosed fees, whereas invoice trading, there's usually no fees. For invoice factoring, sellers can become locked into payment contract, whereas invoice trading, sellers can sign up and extract themselves at any time. They can usually pay as they go. So for investment-based crowdfunding, there's equity crowdfunding and property or real estate based crowdfunding, which involves an entrepreneur or a property developer. The benefits of property based crowdfunding will be for investors. There's reduced complexity and risk, and there's diversified investment portfolio. For the borrower, so the property developer, they can acquire financing at a faster speed, and there's higher autonomy and lower fees compared to traditional bank loans. It has two different forms. So equity-based property crowdfunding, it is when investor will be offered a percentage of ownership of the property. And for lending-based property crowdfunding, so when the lender will receive a fixed return that is based on the amount that has been lent and the interest rate. So equity-based is equity-based and lending-based is like a debt. The advantage of that, it has potential to generate higher returns. There are tax benefits. For disadvantage, it is volatile. Returns are driven by the market price. There's due diligence on the companies that run property-based crowdfunding projects. Holding period can be very lengthy for the equity-based property crowdfunding, whereas for lending-based property crowdfunding, it is safer compared to equity. The return on investment is usually more predictable and stable, but it has lower returns due to lower risk, but also similar to the equity-based, the due diligence will be extensive and difficult. So a blended option called convertible debt is also available, which startups acquire funds from investor in the form of loan, which is repaid at a later stage in the form of property shares. Profit sharing or financial return crowdfunding is when businesses sell share of their future profits or royalties to investors in the crowd. When it comes to non-investment based crowdfunding, there's reward-based crowdfunding, which offers tangible non-financial rewards. They can get financial donation in return for a service or product. This form of crowdfunding, it enables businesses to test demand for a product at an early development stage. It is considered to be one of the most cost-effective ways of raising funds. There's no collateral needed, and it is a simple process, but it usually generates only a very small amount of funding, and the idea is exposed to competitors. So donation-based crowdfunding, it builds upon the intrinsic value of a project. So the advantage would be donated funds are received quickly. It can leverage to reach a broader network of people, but it requires marketing, and a number of crowdfunding platforms can keep a percentage of the donations as a fee. What is an initial coin offering? It enables firms to raise substantial funds quickly and cost effectively at at a very early stage of the business's development. So it enables businesses to sell utility or access tokens compliant with Ethereum's ERC20 standards. What is initial exchange offering? So it aims to provide improvements over the ICO system. So essentially IEOs follow the same pattern as ICOs, but a cryptocurrency exchange known as Launchpad acts as an intermediary and conducts and underwrites the sales. For ICOs, the fundraising campaign is conducted via the token's issuer's website, whereas for IEOs, it is conducted via the website of the cryptocurrency exchange. The crowd sale is managed by the crypto startup for ICO, by the cryptocurrency exchange for IEOs.